Imagine you're behind the wheel of this incredibly high-performance, just ridiculously overpowered sports car,
Oh, that sounds like a good time.
right? But, well, wait. You have the pedal pressed absolutely to the floor. You are doing well over 100 miles an hour on this winding mountain road.
Okay, getting stressful.
Yeah, because there's this massive, literally life-threatening problem. You have severe tunnel vision. I mean, you are staring exclusively at the speedometer.
Oh, wow. Yeah, that's bad.
It's terrible.
Yeah.
You're completely ignoring the sound of the engine struggling in the wrong gear, right? You aren't feeling the vibration of the tires, losing grip on the asphalt. You aren't looking at the weather conditions at all.
Let alone the other drivers, right?
Exactly. You're definitely not paying attention to the other drivers swerving around you. You are just watching that little digital needle tick up and down, and you genuinely believe that the needle itself is what is propelling the car forward.
Which is just a guaranteed spectacular way to crash.
100%. It sounds insane.
Mm.
But that scenario is exactly how, probably 90% of retail traders are operating the cryptocurrency markets every single day.
Yeah, unfortunately, that is spot on.
They are obsessing over the surface level price on a screen, watching the green and red candles tick up and down, while being utterly blind to the heavy mechanical engine underneath that's actually causing the movement.
It is a terrifying way to navigate any environment, let alone, one of the most volatile financial arenas in human history.
Right.
Because operating like that, it provides this deeply intoxicating yet entirely false sense of control.
Oh, for sure. The illusion of control.
Exactly. You see the price ticking up on your screen, and you start assigning emotion to the math.
You think the market is happy.
Right. You assume the market wants to go higher. You start thinking the asset has momentum or desire or like gravity, but because you are blind to the actual mechanic.
The gears turning beneath the glass, right?
Yeah, exactly. The gears. Because you can't see them, you are always reacting to what just happened. You are never anticipating what is mechanically forced to happen next.
And changing that exact dynamic is our mission for this deep dive today. We are going to completely rewire how you see financial markets. We're going down to the studs.
I love that. Down to the studs.
Yeah, we have to. We are going to dismantle the illusions, the bad habits, and honestly, the fundamentally flawed education you've likely absorbed over the years.
Which is most of what's out there.
Exactly. And we're going to rebuild your foundation based entirely on mechanical reality. And our guide for this massive paradigm shift is an absolute masterwork called the Crypto Trading Bible.
Such a phenomenal resource.
It really is. But I want to set the tone immediately for you guys listening. This is not a fluffy motivational self-help book for finance.
Definitely not.
It's not a list of secret cheat codes or, get-rich-quick setups. It is a dense, comprehensive, 700-plus page operator's manual.
Operator's manual is the perfect phrase for it, honestly.
Right. Because it's designed to keep you alive and profitable in an environment that is specifically engineered to take your money.
Yeah, and what makes this material so incredibly potent is the unique synthesis of the two minds who authored it, Attila Szymczak and Tony Eustein.
Such a fascinating duo.
They really are. They don't just offer theories, They offer this unified framework built from two radically different yet perfectly complementary paradigms.
And their backgrounds are absolutely crucial to understanding why this manual hits so hard. Let's look at Attila first.
Yeah, Attila's background is wild.
He's a highly experienced international crypto trader born in Turkey, deep operational experience across the Netherlands, Germany, Russia.
But the kicker is the martial arts.
Yes. The element that changes the entire texture of this book is that he is an advanced martial artist. He doesn't look at the market like a casino at all.
He looks at it like a combat scenario.
Exactly. He brings this incredibly intense, high-stakes philosophy of physical survival, breath control, emotional regulation under extreme pressure.
And millimeter-perfect timing.
Right. He approaches trading with the mindset that survival fundamentally outweighs aggression. You don't strike wildly, you wait for the opponent to overextend, and you capitalize on their structural weakness.
And balancing that intense, combat-focused psychology is Tony Eustein,
The systems guy.
the ultimate systems thinker. Tony's expertise lies in taking incredibly complex, seemingly chaotic structures,
Whether they're informational or psychological.
or financial, and he decodes them into readable, highly repeatable processes. He is the primary architect of the mechanical frameworks we are going to explore today.
He's the filter.
Exactly. He separates the actual market signal from the overwhelming noise. So when you put Attila's survival mechanics together with Tony's structural engineering, you don't just get a book about how to trade.
You get a blueprint.
You get a blueprint that decodes the literal underlying physics of market structure.
Man, that gets me fired up. Let's jump straight into the deep end, starting with what they present as the most jarring, uncomfortable premise of the entire manual.
The price illusion.
Yeah. It is a concept that forced me to completely reevaluate every single chart I have ever looked at. The premise is this. Price does not want anything.
It's a tough pill to swallow for most traders.
It really is. I am so guilty of anthropomorphizing the market. I'll look at a daily chart and say, oh, Bitcoin looks really heavy today, or Ethereum really wants to test 4,000 this week.
Right, giving it human desires.
Exactly. But the authors brutally dismantle that. They state explicitly that price is an illusion. The chart you are staring at is just the exhaust. The engine is the order book.
That right there, that is the ultimate paradigm shift. If you cannot make that mental leap, everything else in the manual will just fall completely flat.
You have to accept it.
You do. When you look at a candlestick chart, you have to realize you are looking at a tombstone.
A tombstone, wow.
Yeah, you are looking at history. Price is simply the permanent record of the last agreed transaction between a single buyer and a successful seller. That is literally all it is.
It's just a receipt.
Exactly, a receipt. It possesses no desires, it has no intentions, and it carries no independent momentum. It is strictly the output of an order-matching engine processing numbers.
So why do we all focus on it so much?
Because traditional retail trading education is fundamentally broken. It conditions people to worship the exhaust rather than study the engine. It teaches traders to rely almost exclusively on lagging indicators.
We are talking about the classic toolkit here, right? The Relative Strength Index, or RSI, the MACD, Bollinger Bands.
All of them.
The colorful lines that every single retail trader immediately slaps onto their TradingView charts the exact second they open a brokerage account.
Precisely. Let's unpack the actual mathematics of lag because it is crucial to understand why these tools fail you. Take a standard 50-period simple moving average.
Okay, the 50 SMA.
What is it actually doing? It is literally just taking the closing price of the last 50 candles, adding them up, and dividing by 50.
Just basic arithmetic.
Right. It is plotting a visual representation of exactly where the price has been. It has zero forward-looking mechanisms. Indicators are derivatives of price.
Okay, I see where this is going.
And remember, price itself is already a derivative of the underlying order matching process. So when you base your financial decisions on a moving average crossing an RSI threshold, you are operating 2 full layers removed from actual market reality.
Oh, man. 2 layers removed.
You are reacting to the shape of the smoke billowing out of the exhaust pipe, entirely blind to the fuel being injected into the engine.
Okay, I hear that, but I really have to push back here, because this is where my brain gets completely stuck.
Go for it.
I struggle to just throw out the RSI entirely. The book calls it an illusion, but I've literally watched Bitcoin hit a 15 RSI on a daily chart.
Everyone screams is massively oversold.
Right. Everyone says it's oversold.
Right.
And the very next day, it bounces beautifully. If millions of us across the globe are staring at that exact same 15 RSI, and we all hit the buy button because we believe the signal, aren't we essentially creating a real mechanical wall of buyers?
You are?
So how is that an illusion if the collective belief physically moves the market? Doesn't the illusion become reality at that point?
That is exactly the trap, and it is a brilliant point to bring up. The authors dedicate significant time to this exact phenomenon in the book.
Okay, so they address it.
Oh,
Yeah.
you are describing a self-fulfilling prophecy, and yes, indicators do appear to work sometimes, but here is the critical distinction.
What's the distinction?
They do not work because the mathematical formula of the RSI possesses some mystical predictive power over the asset.
Right, so it's just math.
Exactly. They work temporarily because a critical mass of retail participants all share the exact same psychological trigger and place their orders simultaneously. You all buy, the influx of market orders consumes the available sell-side liquidity, and the price naturally ticks up.
Exactly. So the indicator makes me money. It looks like a total genius move.
It looks validated, yes. But relying on that dynamic is the financial equivalent of playing Russian roulette.
Wow. Why?
Because the participants who actually control the market,
The big guys.
the massive institutional algorithms, the foundational entities, they also know you are looking at that 15 RSI.
Oh, I see.
When an institution has an absolute mandate to offload, say, 10,000 Bitcoin, they cannot just market sell it, or they would crash the price and destroy their own execution average.
Direct their own position?
Exactly. They require massive, dense pockets of willing buyers to absorb their sell orders. So what do?
They wait.
They wait. They patiently let the price bleed down until the RSI hits that magical 15 level. They wait for retail traders to blindly start firing off buy orders because the indicator flashed oversold.
And then they strike.
The exact second that artificial indicator-driven demand spikes, the institution dumps their massive position directly into it.
That is brutal.
The RSI didn't predict a reversal at all. It simply broadcasted to the institutional algorithms exactly where retail liquidity was resting and ready to be harvested.
That is such a chilling way to look at it. The indicator isn't a map for me. It's literally a homing beacon for the predator.
Homing beacon is exactly right.
So if the price on the chart and the indicators are just the exhaust fumes, and relying on them makes you target practice, what is the actual fuel? How do we look at the engine?
This brings us directly to the mechanical reality of the market, liquidity and the order book.
Let's dive into that.
If we zoom out and look at the actual infrastructure, every single cryptocurrency exchange, whether it's Binance, Coinbase, Kraken, it doesn't matter. They are all ultimately just massive high-speed databases.
Just servers matching numbers.
Exactly. That database is filled with resting orders. You have buy orders waiting patiently to be filled at lower prices and sell orders waiting to be executed at higher prices. That central limit order book is the entire universe. There is nothing else.
No magic, just the book.
Right. And to decode how price moves through that database, you have to completely abandon the idea of bulls and bears.
Which is hard because that's all financial media talks about.
It's completely irrelevant. You have to understand the only two roles that actually exist mechanically, market makers and market takers.
I'm really glad you brought this up because a lot of people hear those terms and think they just mean buyers and sellers. But it is fundamentally about how you interact with the database, right?
Exactly.
We aren't going to bog down in textbook definitions, but we need to talk about the implications of these roles.
Right, because the implications are everything. We know that market makers provide liquidity by placing resting limit orders, and market takers consume that liquidity by executing market orders.
They take the liquidity off the table.
Exactly. But the implication that most traders miss is about energy and efficiency. The market makers are building the scaffolding. They control the spread, which is the gap between the highest bid and the lowest ask.
Okay, the spread.
Now, if you are reading the order book, the spread is not just a fee you pay to enter a trade. It is a real-time intelligence feed about the structural integrity of the market.
Yes, the book gives such a phenomenal example of this. When you see that spread artificially widen, it is telling you a story.
A very important story.
Right. If Bitcoin is hovering around 65,000 and the spread is razor thin, say 50 cents, that tells you market makers are confident.
Yep. The market is highly efficient, heavily capitalized, stable.
But if suddenly, without any news catalyst, you watch that spread violently rip open to $10 or $15, you aren't just looking at bad pricing.
Not at all.
You are watching the architects pull the scaffolding down. You are watching market makers yank their liquidity out of the order book because our algorithms are anticipating massive volatility. They are widening the net to protect themselves. You are literally watching a trap being set in real time.
That is the exact mechanical read. A widening spread signals an impending liquidity void.
A void, meaning there's no friction.
Right. It means the market has suddenly become highly inefficient, and in an inefficient market, it takes significantly less capital for a taker to cause a violent, sweeping price swing.
Because there are no resting orders to slow it down.
Exactly. And this is where we arrive at what Attila and Tony define as the fundamental law of liquidity.
This law is what finally made the order book click in my head. I kept picturing price as this hungry mechanical animal.
Oh, I like that analogy.
Yeah, and liquidity, these dense clusters of resting limit orders and stop losses, that's the food.
Right.
The animal does not move because someone drew a perfect Fibonacci retracement or a diagonal trend line on a chart. The animal moves entirely out of necessity. It moves toward the food.
Yeah, it has to.
It moves toward concentrations of liquidity because that is the only place it can efficiently feed and execute large transactions.
Price seeks liquidity. That is the absolute baseline of mechanical trading. If you understand that the market is a liquidity-seeking mechanism, you immediately understand why retail traders are slaughtered with such relentless consistency.
It's just brutal.
Which brings us to one of the most painful, visceral realities explored in the manual. The liquidity sweep. or in retail terms, the fake breakout.
Oh man, this part of the manual was physically uncomfortable to read.
It hits close to home.
Too close. Because it perfectly described every single time I have ever been chopped up in a trade. The authors walk through this highly specific, incredibly common scenario with Bitcoin sitting at $66,200.
Let's break that down.
Yeah, we have to break this down tick by tick because understanding this single maneuver changes everything. Let's set the stage for the listener.
Okay, let's look at the psychology and the mechanics simultaneously. Bitcoin has been chopping in a boring sideways range between 64 and 66,000 for weeks.
Just putting everyone to sleep.
Exactly. Volume is low. The recent daily high is perfectly established at exactly $66,200.
A clear ceiling.
A very clear ceiling. Now, put yourself in the mind of the global retail collective. They are staring at their charts. They see that horizontal resistance line. The crypto influencers on social media are screaming about a massive parabolic bullish breakout if Bitcoin can just cross that $66,200 threshold.
Right, the narrative is perfectly set. FOMO is just building and building.
Yeah.
And mechanically, what does retail do?
What do they always do?
They start placing buy stop orders directly above that line.
Mm.
They think, I don't want to miss the rocket ship. If it breaks $66,200, I want my broker to automatically execute a market buy so I can ride the momentum to the moon.
Yep.
So they are stacking buy orders at $66,210, $66,250. They are literally piling up massive amounts of food for the animal.
Precisely. They have inadvertently manufactured a massive, dense pool of buy-side liquidity just above resistance.
Just waiting there.
Now, shift your perspective to the other side of the screen. Imagine an institutional entity that has been mandated to offload a massive position, say 3,000 Bitcoin.
Okay, that's a lot of weight.
If they market sell 3,000 Bitcoin in a low-volume sideways range, they will absolutely obliterate the order book. They will suffer catastrophic slippage, their average entry price will be terrible, and it will cost their firm millions.
They just can't do it.
They cannot act without counterparty liquidity. They need buyers.
So they look at the order book and they see that massive cluster of retail buy stop sitting just above $66,200. It's a gold mine of willing buyers. But how do they trigger it?
They engineer the breakout.
They force it.
The institution or the algorithms they deploy step in as aggressive takers. They start firing off just enough market buy orders to chew through the thin sell-side liquidity leading up to the resistance.
They deliberately push the price up.
Right. It ticks to $66,180, then $66,190, then $66,200. And then it breaches. The price hits $66,210.
The moment of the trap. The chart prints a massive green candle breaking resistance. The social media feeds explode. The retail buy stop orders are instantaneously triggered. Retail is aggressively, euphorically buying the breakout at market price.
And at that exact millisecond, the institution unleashes their payload. They drop their massive 3,000 Bitcoin limit sell order directly into the teeth of that retail buying frenzy. Every single retail trader who is market buying the breakout is instantly matched with the institution's sell order.
So the institution just absorbs all of it.
All of it. The institution gets their entire massive position filled at a premium local top price with zero slippage because retail happily provided the required liquidity.
It's an ambush.
Yeah.
It is a perfectly orchestrated ambush. Once the institution's selling pressure completely absorbs and overwhelms the retail buying demand, the momentum just dies.
Hits a brick wall.
The price stalls out at $66,250. It hovers for a few seconds, rejects violently, and plummets back below the $66,200 line. The breakout fails.
And this is where the sheer brutality of the mechanics kicks in. Think about all those retail traders who just bought the top. They are instantly underwater. Panic sets in. Where did they place their stop losses to protect their new long positions?
Oh no, they place them right below the breakout level. They place sell orders at $65,900.
Exactly. So as the price plummets, it hits that dense cluster of retail stop losses. A stop loss on a long position is just a market sell order.
Right.
So now the market is flooded with aggressive retail sell orders, which consumes all the remaining buy-side liquidity in the book, forcing the price to crash even faster.
It's a cascading liquidation event.
Exactly. Retail provided the fuel for the institution to enter, and then retail provided the downward momentum for the crash.
It is so wild because when you are sitting in your living room and that happens to you, it feels like a malicious anomaly.
Yeah.
It feels like the universe has terrible luck reserved just for you.
But it's not luck at all.
No.
Mm-hmm.
When you look at it through the lens of the crypto trading Bible, you realize it wasn't luck. It was a perfectly executed, highly systematic liquidity transfer.
A wealth transfer.
Exactly. Which leads us to the critical realization. If we understand that this trap was manufactured, we have to understand exactly who has the power, the capital, and the infrastructure to manufacture it.
Which brings us to the food chain.
Right. The participant hierarchy.
This is a vital conceptual leap. You are never trading against an abstract entity called the market. The market does not exist.
That's a profound thought right there.
You are always transacting against a specific opposing counterparty. And the manual maps out this ecosystem into 6 highly distinct tiers of participants.
Let's run through them.
At the very bottom, serving as the primary source of organic liquidity,
Plankton.
the plankton of the ecosystem. You have retail traders. They're typically emotional, severely undercapitalized, and entirely reliant on delayed charts and social media sentiment.
Okay, the plankton. Who's next?
Right above them, you have professional retail traders. These are individuals who have stripped away the emotion, who operate systematically, and whose primary objective is capital preservation.
But even the pros are dwarfed by the upper tiers, right?
Absolutely dwarfed.
Yeah.
Above them, we have the market makers, whose algorithms control the spread and dictate immediate efficiency. Above them are the institutions.
The hedge funds and prop desks executing large block orders.
Right. Then we have the algorithms, which aren't even human. They are emotionless speed demons executing arbitrage and sentiment scraping.
Right.
And at the absolute apex, you have the whales and foundational entities.
The big bosses.
The sovereign wealth funds, the massive early adopters, the entities who possess asymmetric capital and asymmetric information.
We really need to linger on that phrase, information asymmetry. The gap between what you see and what the apex tiers see is almost unfathomable.
It's hard to even comprehend.
As a retail trader, you are looking at a public delayed candlestick chart on a web browser, reacting to, a CPI data release or a news headline that was priced into the market literal milliseconds after it hit the wire.
By algorithms.
Right. Compare that to an institution. They have co-located servers sitting physically inside the same data centers as the exchange's matching engine to achieve sub-millisecond API latency.
Yep, they're literally closer to the data.
They have access to dark pool data feeds, allowing them to trade huge blocks of volume off the public ledger so you never see them coming. They possess real-time order book depth analysis and proprietary natural language processing algorithms scraping social media to quantify your exact level of FOMO in real time.
Okay, stop right there.
What?
Because when I read that section, or when anyone hears this, the immediate reaction is complete despair.
Oh, absolutely. My reaction to, if I am sitting at my desk with a laptop and a cup of coffee, and I am stepping into an arena against algorithmic supercomputers executing in microseconds, and whales who can literally see the exact dollar amount of my stop loss resting in the database.
It sounds rigged.
Isn't the game entirely rigged? Why on earth would I even open a brokerage account? It sounds like sitting down at a poker table where the house can see your cards, control the deck, and change the rules mid-hand.
It is deeply intimidating, and frankly, it is rigged against the undisciplined.
But what's the hope?
Well, the authors offer an incredibly empowering counter-thesis here. You have to recognize your limitations to find your advantage.
Okay, lay it on me.
You absolutely cannot compete on speed. It is physically impossible. You cannot compete on capital. You will never outspend an institution. But your distinct, highly potent edge as a retail trader is your absolute agility.
Agility. Okay, elaborate on that. You mean the fact that I don't have a giant footprint?
Exactly. Think of an institution as a massive oil tanker or an elephant trying to sneak across a sandbox.
An elephant in a sandbox, right?
An institution cannot move 10,000 Bitcoin without leaving massive, undeniable footprints in the order book. They alter the topography of the market just by existing in it.
They literally make waves.
Exactly. Because your position size is infinitesimal compared to theirs, you have the luxury of invisibility.
Yeah.
You can slip into the market and slip out instantly without moving the price a single cent.
I don't have to engineer a liquidity sweep.
You don't have to engineer anything just to get your order filled. Your entire job is simply to learn how to read the topography, track the elephant's massive footprints, anticipate where it is going to step next, and hitch a ride on its back.
You survive by using their massive, unavoidable manipulations to your own advantage.
Yes, and to actually track those footprints, the authors give us a specific lens. They call it the 3-layer framework.
Ah, yes, the 3 layers. If you are going to survive the hierarchy, This is how you have to view every single chart from now on.
It is a phenomenal analytical model. If you want to spot the institutional elephants, you must look past the obvious. The framework demands you analyze the market in three distinct dimensions.
Layer 1.
Layer 1 is price. This is the surface story. It tells you strictly where the market has been. It is highly visible to everyone. And tragically, it is where 99% of retail traders spend 100% of their analytical energy.
Just staring at the exhaust.
Right. But the real operators drop down to layer 2, liquidity. This is where you analyze the fuel.
The combustible gas resting underneath it.
Exactly. You stop looking at where price is and you start looking for where the food is resting. Where are the massive clusters of retail stop losses? Where are the psychological round numbers like, $70,000 that retail traders absolutely obsess over? You map out the zones where transactions can efficiently occur.
And then you descend to the final depth, layer 3, intent, the motivation.
The intent is everything.
This is where you leverage derivatives data to understand why the participants are moving the price. This is where you look at funding rates, open interest, on-chain analysis. For example, if you see the price of Bitcoin chopping perfectly sideways for a week.
So layer 1 looks completely dead.
Right, layer 1 is flatlining. But you look at layer 3 and see that open interest is steadily skyrocketing. What does that tell you?
It tells me that new money, massive leverage, is quietly entering the system even though the price isn't moving.
Exactly. It tells you an institution is quietly, systematically accumulating a massive position, absorbing all the selling pressure to keep the price flat so they don't alert the market before they are ready.
They are coiling the spring.
Coiling the spring, exactly. So, if you are only looking at layer 1 price, you are essentially reading the last page of a complex murder mystery and trying to guess the entire plot.
You're flying blind.
You need to map the liquidity and decode the intent to understand the full narrative. And now that we understand exactly how the market operates mechanically, who we are up against, and how to read their footprints, we reach the absolute core of the crypto trading Bible.
The implementation.
How do we systematically, ruthlessly exploit this?
This brings us to the author's proprietary operational model, the Trinity Engine.
The Trinity Engine is where the theory becomes lethal. It is the framework, Attila and Tony, designed to turn observational data into precise, repeatable execution.
It's built on 3 pillars, right?
3 immutable pillars: bias, trap, and execution. Let's unpack the first pillar, bias. Because in normal conversation, having a bias means you are prejudiced or making an emotional assumption. Usually, retail bias sounds like, well, I feel like Ethereum is going to pump today because the CEO of some tech company tweeted about it.
That's hope, not bias.
Right. But in the context of the Trinity Engine, bias has nothing to do with your feelings. It is strictly about evidence-based directional probability.
Correct. Bias in this system is a cold, calculated state of the environment. You do not construct bias by consulting a crystal ball. You construct it by reading the mechanical data.
You look at the order book.
Exactly. Are the massive sell walls suddenly being pulled? Is the bid-ask spread actively compressing, signaling that market makers are anticipating an upward expansion? You look at on-chain metrics. Are thousands of Bitcoin flowing out of exchange wallets into cold storage, significantly reducing the available supply?
Right, you're gathering evidence.
When you compile this hard data, you aren't guessing the future. You are calculating which direction currently requires the least amount of mechanical energy for the market to move. You are identifying the path of least resistance.
Okay, so you have your bias locked in. You know the probable direction. The second pillar is the trap. And this requires a massive psychological shift.
A huge shift.
Because the authors state quite boldly that the market's primary job is to deceive you. If the setup looks incredibly obvious and perfectly clean, you are probably the target.
We explored the mechanics of this with that $66,200 liquidity sweep earlier. The trap pillar is about proactive anticipation. It is about recognizing exactly where the deception will be staged.
You have to assume it's coming.
You do. Remember the core rule. Institutions require retail liquidity to execute their block orders. They actively engineer false breakouts and fake breakdowns.
A concept the authors call inducement, right?
Inducement, exactly. They induce retail into providing the frictional fuel they need. They will deliberately induce retail traders to go aggressively long at a major resistance level, trapping them. Precisely so, the institution has a wall of buyers to sell into.
So how does the Trinity operator handle this?
As an operator, your job is to scan the chart, locate the most obvious textbook technical level, the exact trend line that every amateur online is currently drawing, and anticipate the trap being sprung right there.
I love viewing it as a military operation. Your bias
Yeah.
is understanding the terrain, the weather, and the flow of the battlefield.
Right.
The trap is utilizing your intelligence to anticipate exactly where the enemy is going to stage their ambush. And once you know where the ambush is, you arrive at the third pillar.
Yeah.
Execution, the sniper shot.
Execution is where you separate the analysts from the operators. Execution is about precision over prediction. The manual outlines several highly specific, deeply detailed execution models, but to really understand the application, let's do a deep dive into Model C.
Model C, they call it the liquidity sweep fade. Yes, this is my absolute favorite setup in the book because it literally weaponizes the exact fake breakout that used to destroy my account. Let's walk through the exact sequence of how an operator executes Model C.
In Model C, you have already established your broader bias, and you have identified the primary trap zone. Let's use that $66,200 resistance level again.
Okay, the scene of the crime.
The amateur retail trader places a buy order to enter on the breakout. The Trinity operator does the exact opposite. You absolutely do not enter your trade before the level is breached. You sit on your hands.
Which is so hard to do.
It takes discipline. You wait with militant patience for the price to sweep above $66,200. You watch the volume spike as the retail buy stops are triggered.
You literally watch the trap spring shut, but you still don't act, right?
No, you wait for the confirmation of exhaustion. You wait for the immediate violent rejection.
And the snapback.
Exactly. The exact moment the price spikes up, hits the institutional sell wall, and violently reverses to close back below the $66,200 level, that is your trigger.
Okay, so that's the signal.
You enter your trade in the opposite direction. You enter short on the rejection, placing your stop loss just above the very tip of the trap candle. You take this trade knowing, with near mathematical certainty, that the retail liquidity pool has just been ruthlessly harvested, the institution has secured their position, and they are now going to drive the price violently in the other direction.
It is so brilliantly, viciously counterintuitive. You are literally trading the exhaustion of the retail crowd.
Yeah.
You are stepping in right when everyone else is panicking.
It's the ultimate contrarian move.
But, and this is a massive but, here is the harsh, undeniable truth of the markets. Even with a perfect sniper shot, even with the Trinity engine humming flawlessly, you are going to miss.
Absolutely. You will lose trades.
The trap might be deeper than you thought. A macroeconomic news event might just obliterate the order book. You are going to take losses. And that reality is where Attila's martial arts philosophy entirely takes over the manual.
Section 5.
Exactly, Section 5. The survival imperative and the discipline protocol.
This is, without a doubt, the most sobering, uncomfortable, and absolutely essential section of the entire 700-page manual. The author stated with brutal clarity, professional trading is not about making money.
It's strictly about not losing money.
Yes. Consistent profit is simply the natural byproduct of becoming exceptionally systematically good at not taking catastrophic losses.
It sounds so pessimistic on the surface, but it is entirely grounded in the cold, hard mathematics of risk. They call it the law of asymmetric outcomes. I think we need to do the math of destruction here, because when you actually hear the numbers, it fundamentally alters how you view a stop loss.
The math is terrifying, and it is the silent killer of every amateur.
Walk us through it.
Let's say you start with a $10,000 account. You take a trade without a stop loss, it goes against you, you hold on hoping it bounces.
We've all been there.
And you eventually close it out for a 50% loss. You are now down to $5,000. The amateur mind thinks, okay, I just need to make 50% on my next trade to get back to even.
But that is mathematically false.
Completely false. To get back to your original $10,000 from a base of $5,000, you don't need a 50% gain. You need a 100% gain. You need to perfectly double your money just to get back to zero.
And it gets exponentially worse the deeper you go. If you let ego take over and you suffer an 80% drawdown, leaving you with $2,000, you need a 400% gain just to break even.
A 400% gain is nearly impossible.
You have entered an unrecoverable mathematical gravity well.
Exactly. This is why the authors argue vehemently that moving a stop loss in the middle of a trade simply to avoid the psychological pain of admitting your thesis was wrong is literal mathematical suicide. You are risking a permanent, catastrophic drawdown simply to protect your fragile ego.
Which brings us to the core issue and the absolute focus of the discipline protocol. Because let's be honest, every single trader listening to this right now knows they shouldn't move their stop loss.
Everyone knows the rules.
Everyone knows they shouldn't revenge trade after taking a brutal hit. We all know the rules, but we do it anyway. The anxiety spikes, the heart races, the screen turns red, and we panic.
It's a human element.
So if I know the rules of survival, but I know that I cannot rely on my own willpower to follow those rules in the heat of the moment, how do I stop myself from self-destructing?
You stop yourself by accepting a profound psychological truth that Tony Eustein outlines perfectly. Human willpower is finite, it is deeply emotional, and it is entirely unreliable under stress.
Willpower is finite.
The authors argue that if you construct a trading plan that relies on your raw willpower to execute, you will eventually, inevitably fail. Your willpower depletes throughout the day.
Decision fatigue.
Exactly. As you get tired, as you get hungry, as you get stressed or emotionally hijacked by a loss, your prefrontal cortex shuts down and your amygdala takes over. You revert to a state of raw fight or flight.
So what is the systemic solution? If I can't trust myself, what do I build?
You build system design. You must deliberately engineer friction into your bad habits and remove all friction from your good habits. You have to take the decision-making process completely out of your own hands while you are in the active trading window.
For example,
The manual mandates the absolute use of OCO orders. One cancels other.
let's explain the mechanics of that because it's a total lifesaver.
When you enter a trade, you do not just hit buy and then manually monitor the price. The exact second you enter the trade, your precise stop-loss order and your precise take-profit order are submitted to the exchange database simultaneously.
They are hard-coded into the system.
Exactly. If the price hits your target, the system sells for a profit and automatically cancels the stop-loss. If the price drops, the system triggers the stop-loss and cancels the profit target.
You don't have to choose.
You do not manually manage the exit based on how you feel while watching a fluctuating one-minute candle. The system executes the exit flawlessly, entirely bypassing your emotional state.
They take it even further than software, too. They advocate for building what they call a trading constitution, or an execution oath. This isn't just a sticky note on your monitor with a few setups on it. It is a physical, formal document that outlines your exact operational identity.
Yes, the execution oath is brilliant. It details your absolute non-negotiables. It includes statements like, I am a systematic operator. I risk no more than 1% of my total equity per trade.
Powerful statements.
I will automatically shut down my charting platform and walk away from the computer after 3 consecutive losing trades, regardless of how I feel. You physically sign this document. You read it out loud before every single trading session.
Out loud.
Out loud. The psychology here is powerful. You aren't relying on willpower to stop you from revenge trading. You are simply aligning your physical actions with a predefined, deeply ingrained professional identity. You are removing the chaos of choice during market hours.
It is treating trading with the exact same gravity as operating a highly dangerous, lethal piece of heavy machinery. You do not just feel your way through operating a construction crane while tired. You follow the mandatory safety protocol, or you die.
Exactly. Or you crash.
And once you have mastered that survival protocol, once you can execute the Trinity engine perfectly without letting your ego obliterate your account, the manual elevates you to the final tier. Section 6. Advanced synthesis and the business of trading.
This is the inflection point where you transition from being a highly skilled retail speculator into a true professional operating a scalable business. And achieving that requires synthesizing highly advanced, multidimensional data streams.
The book goes incredibly deep into algorithmic and microstructure analysis in this final phase. It talks about recognizing the literal footprints of machines, things like spotting simultaneous, perfectly correlated price moves across 5 different exchanges within a span of 10 milliseconds.
Right, identifying the bots.
When you see that, you know immediately that arbitrage algorithms are driving the price action, not organic human buying demand.
Precisely. You learn to differentiate between organic volume and algorithmic manipulation. And furthermore, it completely shatters the crypto bubble by expanding your view into cross-asset correlation.
Zooming out.
The professional crypto trader does not operate in a vacuum. They do not just watch the Bitcoin chart. They are deeply monitoring the S&P 500 to gauge the global macroeconomic risk appetite. They are obsessively watching the DXY, the US dollar index.
This is so important. Why does the DXY matter so much mechanically?
Because Bitcoin and almost all crypto assets are priced and denominated in US dollars. It is an inverse mathematical relationship.
Like a seesaw.
Exactly. If global bond yields rise and the dollar significantly strengthens, it acts as a massive mechanical headwind for Bitcoin. You could have the most perfect Trinity engine setup on the Bitcoin chart, but if the DXY is simultaneously experiencing a massive breakout, your trade is highly likely to fail.
Because the macro liquidity is flowing out of risk-on assets and into the safety of the dollar.
Right.
And then they layer in advanced on-chain data. They talk about reading perpetual swap funding rates to detect when retail is massively over-leveraged long, which provides the perfect fuel for a long squeeze trap. They track exchange wallet flows to spot whales accumulating thousands of coins during a boring, sideways range weeks before the price ever breaks out.
It's a lot of data.
Okay, I have to push back here. I have to throw my hands up. Because reading this section, I started to feel a profound sense of overwhelm.
Totally understandable.
Order book depth, macroeconomic yields, the S&P 500 beta, algorithmic arbitrage footprints, on-chain data, funding rates. This sounds like I need to build a NASA control room with 12 monitors, a Bloomberg terminal, and a team of analysts just to place a simple swing trade.
That is an incredibly common, totally valid, and highly dangerous reaction. And the authors explicitly warn against it.
Good, because it's too much.
If you try to track all of those disparate data feeds simultaneously without a rigid filtering system, your brain will short-circuit. You will suffer from crippling analysis paralysis. You will never take a trade because there will always be one conflicting metric.
So what's the solution?
The solution they provide to combat this overwhelm is a concept called hierarchical integration. You do not treat every piece of data equally.
Okay, I need you to break down this hierarchy because it is the only way to stay sane.
You structure your data intake into 3 rigid tiers, and they act as sequential filters. Tier 1 is always your foundational mechanics.
The baseline.
This is the absolute baseline. Market structure, the order book, and price action. If your Tier 1 data does not present a clear bias and a clear track, you stop immediately. You don't even look at the rest.
You just walk away.
Now, if Tier 1 gives you a green light, you move to Tier 2. Confirmatory data. This is where you check your derivatives funding rates or your macroeconomic cross-asset correlation to ensure the broader global market aligns with your localized Tier 1 thesis.
Okay, and if that aligns?
Finally, you move to Tier 3, contrarian sentiment. You look at social media exuberance or extreme algorithmic positioning to ensure you aren't accidentally buying exactly when the public crowd is completely euphoric.
It's a funnel. You scale into the complexity gradually. You don't build the NASA control room on day one. You build a simple, clean dashboard. You master Tier 1, and maybe 6 months later, you add one single new metric from Tier 2.
Exactly.
You let the complexity serve the execution system, rather than letting the complexity overwhelm the operator. And this systematic evolution leads directly to what the authors call the master's path. This is the final evolutionary stage of a trader.
Yes. A master trader operates on a completely different plane. They deeply understand the concept of strategy decay.
Strategy decay.
They know that an edge, a specific mechanical setup that prints money today, will eventually be identified and arbitraged away by institutional algorithms. Therefore, they do not cling desperately to one single strategy.
They adapt.
They manage a dynamic portfolio of edges. They are constantly innovating, backtesting new behavioral models in the background, while simultaneously executing their current edge in the live market.
And the final ultimate step of mastery they talk about is something that really resonated with me. Teaching others.
It's the ultimate test of understanding.
By articulating these incredibly complex mechanical and psychological concepts to someone else, you force your own brain to clarify them. You solidify your own neurological pathways. You build a disciplined community around you. And you finally transcend the solitary, highly stressful, isolated life of a solo retail trader staring at a screen in a dark room.
It beautifully completes the operational cycle. You evolve from being a blind victim of the market's hidden mechanics to a dedicated student of them, to an active, profitable operator exploiting them, and finally to a master who shares the blueprint to elevate others.
Which perfectly wraps up the massive foundational paradigm shift offered by the Crypto Trading Bible. It literally takes you by the shoulders and shakes you awake.
It definitely wakes you up.
It pulls you out of the matrix of lagging indicators, emotional self-destruction, and social media hype, and gives you the tools to become a cold, systematic operator who reads the literal mechanical gears of the market.
It is the stark difference between hoping the market magically moves in your favor and mathematically positioning yourself in the exact location where the market is mechanically forced to go.
I cannot emphasize this enough. You need to get your hands on a copy of the Crypto Trading Bible by Attila Szymczyk and Tony Justine. What we have done today is merely peer through the keyhole. We have barely scratched the surface of this massive 700-plus page masterwork.
We really haven't even touched the surface of the math.
The manual includes exact mathematical position sizing formulas to manage risk down to the decimal. It includes intricate, multi-stage exit matrices to scale out of trades and secure profits while letting runners go. It features dozens of step-by-step, minute-by-minute trade walkthroughs that show the Trinity engine operating in live, chaotic market conditions. It is an absolutely indispensable manual for anyone who is serious about surviving this arena.
It will completely and permanently change the way you interact with financial markets. You will never look at a candlestick chart the same way again.
So, as we close out this deep dive, I want to leave you with a final, lingering thought built on everything we've unpacked today. We have spent an hour talking about the dark side of the mechanics. We've talked about traps, about massive institutions engineering liquidity sweeps, about high-frequency algorithms hunting your stop losses.
It sounds bleak when you list it out.
It does. When you learn all of this, it is incredibly easy to view the market as this malicious, predatory entity that is specifically out to get you. It's easy to feel victimized, but what if it isn't malicious at all?
Just a machine.
What if the market possesses no malice, no anger, and no intent toward you whatsoever? What if the market is simply a perfectly emotionless, highly efficient mirror? A mirror that reflects your own lack of preparation, your own lack of systemization, and your own lack of emotional discipline right back at you in the form of a declining account balance.
A perfectly rational mirror that only punishes you when you boldly violate the mechanical laws of reality.
Exactly. So tomorrow morning, when you sit down at your desk, turn on your monitors, and open your charts, how will you change what the mirror sees? Will you be staring blindly at the digital speedometer, gripped by tunnel vision, waiting for the inevitable catastrophic crash? Or will you finally lift your eyes, look deeply at the road ahead, listen to the heavy machinery of the engine, and actually learn how to drive?